Hi, I'm Gill Witham and I'm a Senior Financial Advisor at Five Financial. And I'm here today with David Bassanese from Betashares, who's the Chief Economist here and also the Chair of the Investment Committee. And we're going to be talking about the most recent market updates and some portfolio changes. And we're fortunate enough to be joined by Cameron Gleeson. He is the Senior Investment Strategist here at Betashares, and he'll come and join us after David's finished to talk about smart beta and what that means. So, David, there's been a lot transpiring in global markets since the last update. We've got a lot of our clients who are maybe concerned about what's going on in the States and political climate over there, and also just the increasing valuations of shares over there. So we're just keen to know what have been the key developments.
Firstly, the US is obviously always the most important economy in the world, and what goes on in the US is the most important thing. The government shutdown, so the federal government shut down. It's been the longest shutdown in history. It went for almost a couple of months. A couple of things about that. Firstly, we didn't get a lot of economic data through that period, so there's not the usual level of visibility in terms of how the US economy is going at the moment. There were some concerns about the longer the shutdown went, the greater the negative hit to economic demand, because a lot of public sector workers in Washington, for example, would be forced to be cutting back on their spending and whatnot. So that was one issue. Now that's been resolved. The government has reopened and the data is starting to trickle out again. So that is one risk factor that has came and gone. The other one is AI, as you mentioned. So AI, I think really since ChatGPT was launched in late 22, has been seen as a tailwind for markets. It's been seen as a positive. Businesses have been investing a lot of money in data centers and computer chips, underpinned by very strong corporate earnings by the Mag 7. I mean, they're basically investing billions of dollars in this area, but they've got the money to do it. And so far, at least, it's been seen as a positive by the markets. But just recently, through the last quarter, it's now become a bit more of a concern. Are they going to get payback from this massive investment they're undertaking? How long will that be? Are valuations getting a little bit stretched? So that's been a new concern. So AI is no longer that unambiguously positive for markets. But again, our judgment is that if you look at the history of a lot of technological changes, they often start with very good intentions, a lot of investing. There's always question marks about how quick the payback will be. And I'm thinking about, railroads, electricity, even the dot-com internet itself in the late 1990s. And there usually is a period of reckoning where demand doesn't live up to expectations. But at this stage, we think we're still early days in the upswing. So not to say that things won't end in a bubble and think we won't have a period of volatility at some point. But I don't think we're quite there yet, and that's been our judgment. And importantly for the models, it's been our judgment. If you think about investing, there's no sign yet of excess supply of data centers. There's still not enough data centers for the computing that these AI models want. You haven't had you go back to the late 1990s, we had lots of IPOs of like tech wannabes flooding the market, and the market was trading at very high valuations. Today, valuations are elevated. The NASDAQ is trading at 30 times earnings, but back in the late 1990s, it was trading at 70, 80 times earnings. So it's quite a big difference. So again, our judgment at this stage is we're still, at worst, maybe midway through this process. And again, not to say that it won't end in a bubble, but we're probably not there yet. So they've been probably the major developments globally. In Australia, look, the challenge has been we've got the big news was that the Q3 inflation numbers were higher than expected. And the question has been, is that reflective of the demand of the economy picking up, or is it like a one-off thing that isn't likely to persist? Now, we then subsequently got a GDP number, economic growth number for the September quarter, which was also pretty strong. Well, at least the demand side of the economy was pretty strong. So it plays into the idea that demand is strong and that's leading to pick up inflation. So we've seen a big sea change in interest rate expectations in Australia, going from expecting at least one, possibly two rate cuts by the RBA next year to now some chance of a rate rise, and that's been reflected in a shift in interest rates within our market.
So with those rate drops, is it going one way or another where you think it's going to, is there one that outweighs the other as far as a rise or a drop?
Our judgment is that at this stage, I still think the RBA is going to be cutting rates next year rather than raising interest rates. But it really does critically depend on the inflation numbers. So as I said, in Q3, the annualized rate, if you take the rate at which inflation went up in that quarter and you look at what does that mean for the annual rate, it's like 4%, which is above the RBA's 2 to 3% target. But I do think a lot of what we saw in Q3 was one-off restoration of profit margins by businesses that had profits hurt during the economic slowdown that we've had. But I don't anticipate that to be ongoing. And as a result, I do think inflation will drop back down into the 2 to 3% band. And the other thing, we are now getting monthly CPI reports, so we do get more regular reports. So on that view, I still see RBA cutting rates, but not before May. But we do concede that if inflation doesn't drop, the markets may be right and that the next move could be up, which will be certainly challenging for both the bond and equity market here in Australia.
Sure. So I know there was a recent rebalance of the portfolios. So what were some of the key changes that were made in light of all of that news?
Yeah, look, I think the first key change, for pretty much the past year, we've been modestly overweight growth assets, overweight equities versus cash and bonds. Now, we've pruned that back to neutral. And really, it's just because, A, we haven't had the visibility about the US economy in the last few months. There is some concern that maybe the labour market is softening. Also, I think just the shift in sentiment around AI, it's not this unambiguously positive development. There are some question marks that markets are starting to ask. And the markets have had a good run. So we just think it's prudent to take a bit of money off the table and go back to a neutral setting, give us flexibility to move one way or the other going forward over the next few quarters. So that's been a major shift. The other one, in terms of tilts, we still like gold. We still like bonds, despite what I've said about the RBA. In fact, we just see Australian bonds as even better value now. So within the defensive part of the portfolio, we're still underweight cash, overweight gold and bonds. But we're no longer overweight growth versus defensive assets.
I know clients have been quite pleased with the gold performance when we're looking at the reports, which have been quite large.
Yeah, and look, and just on that, I mean, the US central bank is still on track to cut interest rates, probably not only this month, but probably moving into next year as well. There's going to be a new Fed chair next year, and Donald Trump, whoever is appointed, is probably going to be supportive of rate cuts because that's what the president wants, for good or bad. And so I think that uncertainty about the Fed and the lower interest rates is going to continue to support the gold price.
So one new entrance to the portfolio is your new global bond ETF.
Yes.
WBND. So be interested to know and let our clients know what the rationale is that, because it's obviously replaced VBND.
VBND, yeah.
And so be interested in what are the key benefits of that.
Yes.
And if you could explain a little bit about the TOFA, which I believe is one of the tax efficiency measurements that it has. So I'd love if you could explain that a little bit.
The VBND is the Vanguard Global Bond ETF, gives you exposure to the global bond market, very easy in one ETF. We've always not been too comfortable with that. We think there's a better way to get exposure to global bonds. So WBND, which is a Betashares ETF, firstly, it has better tracking error. The traditional bond benchmark globally is something called the Bloomberg Global Aggregate Bond Index. Now, the VBND doesn't actually track that all that closely. Well, it's basically hard to track all of the bonds in the market, and so the Vanguard fund is sort of partly tracks it. Whereas we've partnered with an expert group in Europe who are experts in bond trading, and they are basically going to track the overall index a lot more closely. So that's the first point. Secondly, the TOFA election. So again, a global bond fund is typically hedged. So when you buy global bonds, you then hedge your currency exposure. If you don't, then all the currency fluctuations will affect your income returns. So typically a global bond fund has a currency hedging overlay. Now a TOFA election basically means all the gains and losses from the foreign currency trading associated with the hedging goes to capital account, and it's not immediately passed through to income. Whereas if you don't do that, every gain or loss you make on foreign exchange affects the income you pay out to investors on a regular basis. which adds to the volatility of that income payment.
Stream, yeah.
So there is a facility called a TOFA election. And again, VBN doesn't have it, VBND, whereas we have implemented that with the WMB. So I think that's another important advantage of WBND.
Yeah.
Last but not least, it is slightly cheaper. So they're really essentially the three key reasons we think it's warranted to make this switch.
Okay, thanks for that, Dave. I think that covers everything we wanted to talk about today. So thank you very much.
No worries, thank you.